Hello and welcome back to another video. Today we're going to be looking at mortgage bonds and I'm going to be fully explaining them. Now by the end of this video you're going to understand everything you need to know about them as well as all the benefits and negatives. So make sure you watch this video all the way to the end. So to start with, what are they? A mortgage bond is a type of bond that is backed by real estate holdings or real property. It is secured by a mortgage or a pool of mortgages that are typically backed by real estate holdings and real properties such as equipment. Mortgage bonds offer the investor protection because the principal is secured by a valuable asset. In the event of default, mortgage bondholders could sell off the underlying property to compensate for the default and secure payment of dividends. So how do they actually work? To start with, issuance. When a person buys a home and finances the purchase with a mortgage, the lender rarely retains ownership of the mortgage. Instead, it sells the mortgage on the secondary market to another entity, such as an investment bank or government-sponsored enterprise. From there, there's securitization. The mortgages are then pulled together and securitized into a mortgage bond. These bonds are backed by real estate holdings or real property. Next, there's investment. Investors buy these mortgage bonds from the issuer, and the investor then receives periodic interest payments on the underlying mortgage loans until they're paid off. Next, there's protection. In the event of a default situation, mortgage bondholders could sell off the underlying property backing a bond to compensate for the default. This offers safety and security for investors. Finally, there's a return. However, because of this inherent safety, the average mortgage bond tends to yield a lower rate of return than traditional corporate bonds that are backed only by the corporation's promise and ability to pay. So what are the main benefits? To start with, security. Mortgage bonds offer the investor protection because the principal is secured by a valuable asset. In the event of a default, mortgage bondholders can sell off the underlying property to compensate for the default. You can also claim on property. If a homeowner defaults on a mortgage, the bondholders have a claim on the value of the homeowner's property. The property can be liquidated with the proceeds used to compensate bondholders. And thirdly, it's a safer investment. Mortgage bonds are considered a safer investment than stocks. And this is because they're backed by real estate holdings or real property. So what about the negatives? To start with, there's a risk of losing collateral. If the borrowers fail to make a payment, the lender obtains ownership of the underlying collateral. However, it is not always the case that the lender can sell the collateral for an amount that they can fully cover the loss. There could also be lower yields. The safety feature of these bonds means lower investment returns. Because of this inherent safety, the average mortgage bond tends to yield a lower rate of return than traditional corporate bonds that are backed only by the corporation's promise. There could also be subprime mortgages. If the pool of mortgages includes subprime mortgages, it carries a notorious reputation as well as a higher risk of default. So this has been my video fully explaining how mortgage bonds work. Hopefully now that you've watched this video you understand everything you need to know about them and you can use some of what you learn in the future if you're looking to buy mortgage bonds. If you found this video helpful, please comment down below to say it helped you out and like and subscribe for more content like this. Thanks for watching.